Good morning, everybody. It's great to be here. This is my third Griff, and I've still got something, hope, different to say to you today. And really what I'm wanting to talk about is all about growth strategies for businesses in the food service, in the restaurant sector. So what is it that makes companies grow? And the background to this is based on a lot of work that we do throughout the industry, both in the UK and across Europe. And my comments are European in scope rather than purely UK orientated. And I think there are lessons for the rest of the world as well. So my company provides information about this market, the restaurant market, and many other eating out of home markets as well. And I've pulled together a lot of our learnings for this presentation. So really what I want to talk about is three things. What makes growth possible? Why does growth happen? Secondly, what are the strategies that operators use in order to grow? And thirdly, having grown, how do you cash out and make your money? So those are the three elements. And I want to start off by just very briefly looking at the restaurant market in Europe, which in simple terms you can split into two: full service restaurants and quick service restaurants, which across Europe are roughly the same size. They vary enormously. And I should say, by Europe, I mean everything from Russia through to Iceland, from Finland down to Malta. So we're covering a lot of different countries. So these two sectors are roughly equal in size. They vary in composition enormously. From the type of takeaway that you find in Turkey is very different from the type of takeaway that you'll find in France, for example. So we have a large market that represents a lot of outlets for a lot of different needs. And what is driving growth is basically more business. And if you take the US as an example, then the spend per head in the US is roughly 40% more than in Europe. So we've got a potential growth plan for Europe based on what's happening in America. In the previous session, there were comments about how the UK market is behind Europe, is behind the US in terms of spend per head. It's not as clear-cut as all that, but there is growth opportunity there. So UK is probably, in spend per head, one of the leaders in Europe. France and Italy are higher, and other countries it's less. So there is headroom. And what is it then that is building on this, on the growth trajectory and building into building up into the headroom? There are a number of things. First of all, market maturity is important. Is the market grown up enough to accept restaurant brands? Do people have enough money? Do the type of people who go to restaurants exist in adequate numbers? Just fundamental stuff about the market. Is there an exciting feel to going out in the country or the region that you're looking at? In other words, does the basic groundwork exist for a restaurant market to grow? And secondly, are there niches, are there opportunities, are there things that operators can actually do? Can they distinguish, we heard about burgers, so can you distinguish between a very cheap burger bought off a kiosk van at the side of the road compared with a burger that is served in a very upmarket restaurant? Yes, you can. What are the niches in between? How do you define them? And are there the opportunities? So are there opportunities in the markets that you're looking for? And Are there the entrepreneurs around who are going to take advantage of that? And by entrepreneurs in this sense, I'm including people who are quite happy to entrepreneurial set up one little restaurant and run it for income. But I'm also talking more specifically about entrepreneurs who are going to grow a business with a business plan, with a 3, 5, 10-year plan to grow the business, realize the profit on the business, and take it forward. So do these people exist to grow the market? Are there the people around who are going to take advantage of the niches and opportunities that exist? And then is there the money? Because running restaurants is not cash-free, as you all know. So is there the money? Is it available? Is it readily available? Is it available at prices that are realistic for the market? So there has to be an infrastructure, financial infrastructure, to support the growth of the market. If that infrastructure doesn't exist, then a market will find it very difficult to grow. And then there's the sort of the infrastructural things that are important. Is there a supply chain which can deliver the goods that are required in the right quantities, at the right time, right quality, right price? If that infrastructure doesn't exist, then restaurants are going to struggle to deliver their offer to customers. Is there the workforce available? Are there the right people, front of house, back of house? And is technology being used in intelligent ways for the food service sector? We're still waiting for the killer app in the restaurant sector, but there's a lot of technology that's used, although the industry is a slow adopter of technology. So all of those things then need to exist, and when they do exist, then a market can take off. It happened in the US probably in the 1970s. It happened in the UK and other European markets towards the end of the 1980s and into the 1990s. It happened in Central Europe probably 15 years ago, and in other countries it's just beginning to take hold. So growth can happen when the right seeds are set in the ground. And operators individually can grow in a number of ways, which I'm going to explore over the next few minutes. If we look at the restaurant market in Europe, then we can see that around about 60% are single unit businesses. There is then a growing number of businesses with more and more units. So the businesses with 2 to 4 units represent a relatively small number of the total units, whereas the units with 500 or more, the McDonald's and so on, are between them have a lot of different units. And if you translate that then into a distribution graph, you can see that the smaller unit, the smaller businesses, 2 to 4 units, are in fact, in terms of businesses, there are over 10,000 of those across Europe, whereas there are just a relatively small number of businesses with more than 500 units. So the market is dominated by small businesses, and a small number of large businesses do exist. And they grow their business in a variety of different ways. They can roll out their business, they can franchise the business, and franchising is popular in some countries where there is where it is the most efficient way to utilize capital, where operators don't have their own funds, don't have access to their own funds, or where a company wants to develop a new region where it doesn't have a capability. Other countries are less adept or interested in franchising. So become a franchisee or become a franchisor, go down the acquisition route. Again, this depends on having a sufficiently adequate backing, or go into joint venture in various forms. They exist in various forms. I suppose I can include things like licensing in there. And across Europe, there are different companies who are doing things in different ways, and some companies are doing a multitude of these things. So there is no single way that a company can develop its growth. Getting down to the nuts and bolts of it, then one way to grow the business is just to grow organically. Have a great business, a great unit, use the profits, invest it, grow it, and perhaps at a time have enough money to open another unit. Or alternatively, develop a full-blown rollout strategy, having the money available, having the vision available, having the manuals available, having the capability to develop new sites and so on. So rollout is a popular way of growing a business, particularly amongst private equity firms, because that way they can actually see how businesses can be scaled up merely by opening more restaurants. There are very few businesses where you can double your business overnight. You can do that in the restaurant business if you've got one restaurant and you open another one. So rollout is a popular route. There's also issues about opportunities for growth through rebranding, repositioning, taking advantage of the way that the market is changing, and using that to supercharge growth. There are opportunities to develop new brands in new niches and new opportunities in new markets, as I mentioned before. Or alternatively, developing a business in a totally new sector. There are examples, for instance, of contract caterers who have an in-house restaurant brand and using that, putting that on the high street. And it happens the other way around as well. Developing in a new country is clearly a way of growing the business. And there's been a lot of talk yesterday and no doubt more today about internationalizing, so I won't go into that in a lot of detail. And then I guess there's the disruptor. Is there going to be a disruptor in the food service, the restaurant sector? Well, possibly. The delivery apps will have some disruption. They're not going to disrupt the whole industry, but in places, in towns, in particular market segments, no doubt we will see a major impact from the delivery apps, the Just Eats, the Hungry Houses, Grubhubs, and so on. So, having grown the business, what do companies do about it, and how do they use the equity that they built up in the business and begin to realize that? Well, sort of returning to some earlier chart that I have, if you look at the total market in terms of in terms of the total food service market, only a tiny sliver of businesses have more than one outlet. The previous pie chart that I've shared with you showed the number of units in overall terms. This is the number of businesses. So a tiny, tiny number of businesses compared with the total number of businesses in the restaurant sector in Europe have more than one outlet. But as we saw before, there are a small number of large businesses. And we can categorize these in 2 or 3 ways, and we conveniently do this in terms of brands that we think are bubbling under. So they're still small. They may or may not be brands, depending on how you want to define a brand. But they've got some sort of capability of expanding beyond one outlet. Then they become 5 or more outlets when they actually have quite a lot of capability now, a proven business model that can start to attract money. Yesterday, Sarah Lockyer mentioned the regional brands in the US accounting for 3.4% of the US market. In the UK, we also have a sliver of the market which we call ones to watch, and these are brands that have got 5 to 25 outlets, and they are growing their outlet numbers between at more than 20% over the last 3 years. And there are 170 of those brands in the UK, representing getting on for 2,000 units. So this is the the place where brands become interesting, where private equity starts to take an interest in the market. And then they get bigger and bigger, and you get private equity still involved in all these stages until the brand gets sufficiently large that it can go for a listing. There aren't that many listed restaurant brands in Europe. There are many more in the States, where they understand the restaurant sector, I think, a little bit better than we do. But there is a journey then from individual ownership right through to public quotation. And just to put some sort of names on this, this is taken from some work that we do on a regular basis. There is a heavy emphasis on the UK for two reasons. One, because the audience for this particular bit of research is heavily UK oriented, but also because the brands that are active in Europe, the innovative, the high growth brands, are concentrated at the moment in the UK because there is such a wealth of innovation, entrepreneurship, and finance available. It's happening in other countries too, but not to the same extent. So you can see the journey from the ones that are bubbling under right through to the establishment. Some of these companies are publicly quoted. So there is definitely an escalator that the industry moves up. And it starts with family and friends providing the finance, or the credit card, or the bank loan. Very basic stuff that gets businesses going. And it's at this point where businesses often fail because they run out of money before they can start to make it. Once they're proven and growing, then there are additional ways of funding the business. So suppliers inadvertently become funders to a degree. There are internally generated cash which can grow the business. Then angel investors come in. Crowdfunding is now finding its role in this sector, and we're seeing more new companies coming to seek funds daily. Private equity, and finally listing. So there is an escalator that helps operators to grow their business and to cash in on what I think is a very exciting market. Ladies and gentlemen, thank you very much.